do they have a choice? Is there a choice for somebody in a PayPal situation to embrace DeFi and Ethereum? Is it just a case of them seeing the writing on the wall pretty early on? And then where would fintechs and banks fit in your view going forward?
Sure. So firstly, I think that every fintech company is going to look at Ethereum and Bitcoin and realize that they solve some of their most difficult problems, right? If you're a fintech company trying to operate globally, you have intermediary costs like you cannot believe. For example, a company like a time bank is still not profitable with 3 million users, right? Like, that's just crazy to give you an idea of like the amount of money that has to go into servicing each individual user.
Good day everyone, and welcome to this video. Today I have the EtherBridge guys, Jason and Michael, back, and we have a very interesting discussion for today. We're going to be talking about DeFi. What is DeFi? What is Ethereum? And related topics. So Jason and Mike, welcome. I hope you guys are doing well.
Yeah, thanks for having us back on, Tavish.
Cool. So let's dive straight into it for the benefit of the viewer. Now, there are a lot of buzzwords out there in the blockchain space, but the most prominent, I guess, it's more than a buzzword, it's not a buzzword, is DeFi. I don't think we're at a stage where every individual understands it though. For many people in parts of the world, DeFi is a kitchen appliance, right? Bad joke. But let's start with a very simple question. What is DeFi?
Awesome. So DeFi is the collection of many different programs, or as they're called in the crypto space, smart contracts, that allow us to create trust minimized financial applications. So they're very different to the traditional financial services system that utilizes all these sort of recourse deterring guarantees and delivering any given financial service, and replace those guarantees with game theoretical guarantees, right, or math-based guarantees. So if I had to summarize DeFi in sort of one sentence, it would be an opportunity for the world of financial services to transition from the very expensive, cost-prohibitive world of brand-based trust to move into a new world where math governs trust. So that would be the...
That's a fantastic way of putting it, and I don't think I've heard it quite like that. So we'll come back to everything you've just mentioned, including I made a note of the cost function, which is quite interesting. But then before we talk a bit further about DeFi, we have to talk about Ethereum, which really launched DeFi, even though there are other chains out there. So let's pivot for a bit. What is Ethereum? And why did we need it if we had Bitcoin?
Cool. So Ethereum is incredibly similar to Bitcoin in that it provides guarantees to transacting parties that their transaction will be processed, settled, executed, and settled. The biggest difference, I guess, is in the expressiveness of what Ethereum can offer, right? So Bitcoin can provide those guarantees when people are just transacting Bitcoin. So Jason sending some Bitcoin to Tavesh, I can receive very high settlement assurances from Bitcoin miners. But Ethereum possesses this additional expressiveness in that it is Turing complete, and it can process, execute, and settle basic conditional agreements that we call smart contracts. So Ethereum sort of trumps Bitcoin, not in areas where Bitcoin is special, and I'm sure that we will touch on that later, but it trumps Bitcoin in terms of its programmability. It's essentially, and I like, there's been this narrative about Ethereum as this world supercomputer, and whilst it might be slightly too over, it might summarize the opportunity too much, it's basically a computer in virtual space that people can write programs for and anyone who has an internet connection can request to use those programs known as smart contracts, right? So it increases the expressibility of a blockchain as a transactional ledger where we store who owns what and how much of it they own, to a ledger that can record not just transactions of Ethereum, but essentially transactions of any asset, right? So in the same way that Bitcoin, the network, provides settlement assurances and guarantees to people transacting Bitcoin, Ethereum can provide those same guarantees, but it's asset agnostic, right? So it can process, execute, and settle transactions of value of essentially any asset,
Right.
which really opens up its usability and its capabilities in society.
Right. Right. So just a quick recap then. Ethereum was a new blockchain that came out after Bitcoin. And this is very simple. Some of you viewers know this already, but we'll get more complex. And it had the ability to deploy programmable smart contracts onto that blockchain. Those are effectively units of code that run decentralized around the world. They could be autonomous. They are immutable. You can't shut them down. You'd have to shut the entire Ethereum network down. And that opens up opportunities for us in all types of industries, but I guess primarily the financial services industry. That brings us to DeFi. So, how is DeFi then different to what people are now calling TradFi, traditional finance? Or why are those smart contracts so important in disrupting this entire industry?
Awesome. Yeah. So I think I'll answer that in sort of two pieces. The first being smart contracts, and then the second being a comparison to fintech and TradFi. Right. So smart contracts really change the way that human beings will make agreements and sort of execute those agreements. Right. So contracts historically have always had a separation between the agreement itself and its final enforcement, and that separation has always meant that we need trusted, capable third parties to sort of slot in between agreement and execution and make sure that those things are enforced, right? Which introduces additional costs into essentially any agreement that we make. So that's the first thing to sort of get about smart contracts, is that they completely destroy the traditional separation between an agreement and its final execution. Then when you start sort of comparing this to the contracts that we use in TradFi and FinTech, and I like to think of it almost on a sort of spectrum, right? So TradFi is the underlying financial network, and it has gatekeepers like commercial banks, wealth managers, asset managers, massive exchanges, the rest of them. FinTech companies have essentially built on top of that existing legacy financial system, and they haven't built from the center of it, right? There's obviously a lot of innovation going on in payments, but they haven't really like built from the center of finance. What they've done is they've built on the outskirts of finance. So they've increased the reach of the traditional financial system by focusing on optimizing on processes or business models on those outskirts.
So hang on, so guys can explain. What you're describing is that the middleman just became better and more efficient, but it was still a middleman system.
Yes, and it was more like a facelift, right? Like
yeah,
most and like fintech is incredible in what it's achieved. But I think if you like go back to first principles of what fintech is doing, all it's really doing is slapping a new user interface on a financial function, right? On a financial primitive, right? Whether it's Lending Club or Square, Cash App, or the rest of them, they're still incredibly centralized, and they've just sort of improved on a lot of processes that other intermediaries have sort of failed on.
Okay. So sorry, Mike. I just want to pivot. You wanted to mention something.
Yeah, I was just going to say, a big part of these fintech networks is a lot of the niches that Jason mentioned they're now servicing weren't serviced before by the bank, just generally because they were maybe too expensive. It wasn't actually going to be profitable. There was never any reason for them to actually reinvent the wheel as a bank. So these fintech networks found really good niche fits, actually, as you say, building out on the outskirts. And the one thing about these fintech companies is they never really changed the underlying business model. They maybe pivoted and tried to make money different ways. I think, as I said just now, Robinhood and the ability to actually charge customers zero fees. All they've done is they've moved where they're getting the liquidity. Now they're getting liquidity from companies like hedge funds. And that results in, again, it's not a complete re-architecture. It's just a change to the business model that's allowed these fintech companies to be massive.
Okay, so this is once again very interesting. So the fintech's built on top of the traditional middleman model, highly efficient. They became very efficient. And what you're saying, I think, is quite important before we continue. It wasn't just about disrupting banks and traditional institutions. They found new niches to basically service. So that's great. That's growing the industry. Let's now pivot back to what we were talking about 2 minutes ago. We've established that we've now got a decentralized blockchain, Ethereum, where you can run smart contracts that can disrupt everything we've just spoken about. Now continue as to how TradFi gets disrupted from here.
Cool. So I like to think of it as TradFi getting enabled from here. I'll get onto the sort of bullish case for commercial banks and using crypto a little bit later. But if you think about so what Mike was basically trying to say is that fintechs came in and serviced either undeserving groups, according to TradFi, or groups that couldn't obtain some kind of financial function, right? So you can think of it in three sort of categories, right? You've got financial services that are enabled for the masses. You've got financial services that are enabled for the few. And then you've got financial services that are explicitly enabled for the privileged, right? So, for example, for the everyday person, it's quite difficult to sort of get leverage against your securities, right? If you're not over a certain threshold. It's impossible to run a business where you can stream money in real time to people working in a distributed team all over the world, right? Like it would be incredibly expensive and cost prohibitive to run a business like that purely because of the cost function of TradFi and FinTech. So what Ethereum aims to do is, instead of building on through those three sort of phases, right? Masses, the few, and privileged. It aims to actually re-architect the entire system, right? And enable all of those use cases by making that cost function lower, right? So even though complexity increases and sort of transaction volume increases, or transaction value, more importantly, increases, Ethereum should be able to, and other layer one networks should be able to granularize those costs and continue on that spectrum of being able to service or democratize all of those services, whether they have previously been enabled for the masses, the few, or the privileged. It aims to democratize all of those functions into a single software-based product that anyone with an internet connection can interact with and enjoy the benefit of any given function.
So to unpack this further then, right? What you're saying is that an entity, which could be a middleman, or all the way through to someone autonomous, we don't even know who wrote a smart contract. So an actor could write a smart contract offering services, and those services could get more and more complex to the point where I could take out a loan just interacting with a smart contract that I trust. And I could probably get the loan in Ethereum or some form of cryptocurrency or token. This is going to eat into the bank's business eventually as this grows. So do the banks even know what's about to hit them? Let me put it that way.
Yeah, look, I think that the banks are incredibly well aware of what's coming for them. I've been increasingly impressed by South African banks in general with their general awareness of what is going on in DeFi. And just like we sort of discussed with Bitcoin, this crypto space is bizarre and the investment space is bizarre. People seem to think of things as like binary outcomes, right? So, oh, Bitcoin succeeds, there's no more US dollar, or Bitcoin fails, therefore it's only the US dollar, right? It's not as binary. So in the same way that like even if Bitcoin proliferates, I think that there'll be multiple monies that will coexist. Ethereum as an internet of value, I think will exist as an internet of value in and amongst multiple internets of value, and it'll be able to coexist with them, right? So with time you will see open permissionless public networks like Ethereum servicing a particular niche or acting as like sort of a parallel financial system. But you will also see you'll also see sort of traditional banks releasing their own permissioned open networks, right? So that'll be like a whole separate category of sort of internets of value. And then on top of that, you'll have the very closed, very permissioned central bank digital currency networks. Okay, and I do genuinely believe that these three networks will coexist with one another. And that's why the opportunity is so exciting, because between those three different value nets or internets of value, we will see massive competition in granularizing costs in specific financial services, right? You will be able to move in and out of the closed permissioned system into the open permissioned banking system, and then into the open permissionless Ethereum-based world, or other blockchains. So I do think that they will coexist, and I think that especially the private banking internets of value, remember, they've already captured all of these customers, right? If they start introducing transparency and efficiency gains to products that already exist, that's still a massive win for them. They do have lots of customers already. So I don't see a world in where, you know, Ethereum just, and maybe with time, Ethereum just takes over, but I think that we'll have three distinct internets of value that will coexist with one another, and each internet of value will granularize and optimize itself to sort of unlock efficiency gains in any given function, right?
Yeah.
Yeah, I hope that kind of.
So I like how you've put that. I really found that to be quite interesting. I mentioned loans. Mike, I don't know if you want to dive into some of the other use cases before we explore how we're bringing down costs. So let's talk firstly about how does it look and feel? What type of use cases are we talking about for somebody who's not a fintech expert, who's watching this and learning a lot so far in this video about fintech and DeFi? What else is there as a use case today?
Jason is the DeFi expert, but I think the number of use cases actually being enabled by Ethereum is just mind-boggling. So within the financial or the DeFi sector, all of these, there's been a whole bunch of different financial primitives that have emerged that are now being served, whether it's investing, whether it's trading, whether it's lending, borrowing, paying people, even such things as insurance. These have emerged rapidly. Some are a lot more complex to serve than others. I mean, something like Nexus Mutual insurance is going to be massive. And there's a lot of problems that still need to be solved before it starts hitting mainstream. I mean, from being able to accurately report insurance events to being able to automate payouts, there's a lot of things that still need to be worked on. A lot of these networks, though, especially with something like Ethereum, and that's why we've also found such traction within Ethereum, is all of these financial primitives act as building blocks to the Ethereum network. So if someone is starting a lending and borrowing network or platform, they can actually go and use some form of, as we call them, money Legos or financial primitives in a paying sector in order to help automate payout of lending or borrowing, whatever it is. And Ethereum becomes super composable in this way.
Yeah.
And that actually results in just a really positive network effect for Ethereum at the end of the day.
Okay, but I want to challenge you guys. Everything you're saying sounds great. This is the future. It's a lot more optimized. It's decentralized. We talk about bringing down the cost function and taking out the middleman. Now, I did some research into gas fees, and we've known anyone who's been into Ethereum for a while knows about gas fees. And yes, it's mining. The miners get it now, but we're moving to proof of stake, so it's the stakers. Are we not just transferring cost from traditional middlemen to miners and then stakers? How are we actually bringing the cost down here?
Cool. Yeah. Okay, cool. So like, first of all, obviously Ethereum gas fees right now are incredibly high. And the whole sort of, when we talk about blockchains, we always talk about it as like, oh, well, if their transaction fees aren't incredibly low, then they're not usable, right? They don't, they're not going to sort of proliferate. They're not going to sort of work. I think it's, for Ethereum especially, it's actually like a massive feather in their cap, because high transaction fees right now are speaking to the fact that there is a massive amount of demand for block space on Ethereum at any given period of time, right? So that's sort of one positive to take out of high gas fees. But the whole point about gas fees is thinking back to this sort of this cost function, right? So the legacy financial cost function is filled with all these recourse deterring guarantees, right? Whether it's legal costs, infrastructure costs, having to maintain that infrastructure, having to pay for all the seats within your building, having to pay for all the fixed overheads, and then obviously the ongoing regulatory costs, right? That now competes with an open market for bidding on block space, right? So gas fees are essentially, when they're incredibly high, all they're really telling us is that there is an incredible amount of demand to get in to any given block, and not that much supply to sort of fill that block left, right? So the way in which Ethereum, yes, it has, okay, so let me start again. Ethereum obviously has incredibly high transaction fees right now, but what you're paying for is very high settlement assurances on any given transaction that you're requesting the Ethereum network to perform for you, right? And it is a free market alternative. Okay, that is the cost right now of the resources that are going into providing you settlement. It is a free market for determining how expensive is any given financial function. And with the release of Ethereum 2.0 and in sort of increasing Ethereum scalability and its capability, that should alleviate some of the gas price pressures that we're seeing today. I think the estimates are that Ethereum can be sort of 100 to 1,000x more efficient. So it will be able to compute sort of 1,000 times more than what it can for a similar cost today. But at the end of the day, that gas cost, that crypto cost, which is the transaction fee you pay for whatever you're trying to do, plus the inflation that's incurred within that block, is a free market price for redundancy and tamper resistance of the Ethereum network, right? So,
and as you mentioned, it's an alternative. It's an alternative that would exist. You could use it. Yeah.
That's the point. So like, what are Ethereum miners and validators providing us as Ethereum users? Well, they're providing us with guarantees, right? And those guarantees are, the biggest one is that your transaction won't be reversed once it's reached finality, right? Like, even if you think about businesses like Swift, like that is Swift's core value proposition, right? Once a transaction has been performed, it can't be sort of reorged, it can't be reversed, right? Like irreversibility is a big part of the puzzle. So when looking at gas fees and how expensive they are today, that's just the cost today of getting these very high probabilistic guarantees that your transaction will not be reversed, and that the financial function that you've just used will go through as you initially agreed upon. Remember the smart contract sort of conversation where agreements are tied to its final execution. Ethereum provides me with incredibly high degrees of certainty that when I make an agreement on any of these sort of trust minimized financial applications, that agreement will execute as planned. Right? That's
Right.
like that's what it's providing me. That's the guarantee that it's giving me. And right now, Ethereum gas fees represent the price that we have to pay in order to achieve those guarantees.
Okay.
As Ethereum scales, we'll hopefully see that come down.
Okay. So I want to talk about the role of TradFi going forward. And before we get to the banks, and I know you have a theory on where banks will fit into this world, but let's start by talking about FinTech. Now, PayPal was a FinTech disruptor in the payments sector, and they're known globally, and I think they operate in pretty much every country. And about a year ago, they announced a move to crypto. They took baby steps, and now they're doing it more and more. You can withdraw the crypto. Do they have a choice? Is there a choice for somebody in PayPal situation to embrace DeFi and Ethereum? Is it just a case of them seeing the writing on the wall pretty early on? And then where would fintechs and banks fit in your view going forward?
Sure. So, firstly, I think that every fintech company is going to look at Ethereum and Bitcoin and realize that they solve some of their most difficult problems, right? If you're a fintech company trying to operate globally, you have intermediary costs like you cannot believe. For example, a company like a time bank is still not profitable with 3 million users, right? Like that's just crazy to give you an idea of like the amount of money that has to go into servicing each individual user. So I think the first people that will really lick their lips at crypto are fintech businesses. So businesses that have optimized for a particular use case, that are traditionally built on the legacy financial system and look to utilize the benefits of Ethereum. So I think fintechs will be the first that will start to look at these open permissionless networks and think about how they can integrate them into their business. So swap out the old rails, use the new rails, eliminate a lot of the costs and intermediaries, and hopefully become a lot more profitable at a much lower user base. When it comes to TradFi and how TradFi fits into this over time, I think the one thing that crypto people can't deny is that TradFi sort of owns the user base right now. I wouldn't say that user base is necessarily in love with the commercial banking system, and you can see this if you just go on like a Play Store and you just look at reviews for fintech apps versus reviews for banking apps. I mean, the sort of flippening has already happened, right? Technology is already dominating financial services. I think that TradFi banks will eventually start to integrate, like I said, between those three different internets of value, where they are an open permissioned network. They KYC, the AML, they do the whole works on their clients that operate on their open permission network. They can move from their open permission network into CBDCs and closed government networks. And they can also open up their user interfaces to sort of use cases that are being delivered at a much cheaper cost in Ethereum-based financial services. So remember the three stages, right? Enabled for the masses, enabled for the few, enabled for the privileged. What I think we'll see with traditional finance companies is where recourse deterring guarantees make certain things that people can do with their money cost prohibitive. They will look to open permissioned ledgers and pay that sort of crypto cost, that sort of math-based cost, to provide that service. And they can easily slap on an additional fee in doing that, right? So the user would end up paying an Ethereum gas fee plus an additional fee that would be directed to the bank. So the sooner that banks start to allow their clients to interface with DeFi. Okay, their clients aren't going to be using DeFi to pay for coffee,
Yeah.
right? They're going to be using DeFi to operate a global team where they're streaming their salary to each other in real time, and the bank is just providing the interface for that to happen. I think there are obviously a lot of core functions of banks that are going to come under a bit of a challenge, right? Whether it be lending or allowing for exchange or even asset management. I mean, the asset management landscape is in for quite an interesting time. But TradFi will still, I think, play a part in allowing their clients to interface with these things. You know, we've always thought about banking or commercial banking as just a basic messaging network, right? Where users send requests to the bank, and the bank is charged with the responsibility of, appropriately sort of responding to those requests or executing those requests on behalf of users. Now, Ethereum is very similar. It's just it replaces the bank with a whole bunch of nodes that perform those tasks. So I think with time they will become friends,
Yeah.
and they will leverage one another to enable previously impossible use cases.
So you're saying banks, if they embrace this early, there's a very good role for them to play, and it could be profitable for them. And I know that's what they want. You mentioned opening a permissioned ledger. What is that? Like a Lightning channel or a separate sub ledger?
Yeah. So for example, like a company like Standard Bank, and Standard Bank, funny enough, is actually quite they're already sort of on this trajectory. They might not be working with Ethereum, but they're already on this sort of trajectory. So what we're seeing banks doing is building sort of blockchain agnostic platforms that they can interface with different blockchains that have granularized for specific use cases. That seems to be the best sort of strategy. Now, imagine if not only do you build that user interface, but you build your own blockchain, right? And you allow, yes, it's centralized, yes, it's permissioned. So not anyone can log on to it. They have to have some kind of identifier. They have to have an identity. It's probably going to be their sort of national identity that they'd use on a banking blockchain, a banking permission blockchain. So they've got this capability to capture their users and sort of provide the same sort of efficiencies that people can get in Ethereum, and not use Ethereum for things that they already do well, right? Banks already do payments well. Banks already do the rest well. Yes, they can maybe lower some costs and, achieve settlement at a faster rate, and that would be achieved through using these permission blockchains. But they will leverage one another where they are weak and where open permissionless blockchains are strong. So I do see an intersection where, yes, maybe banks will get a lot smaller over time, and yeah, they probably will. But I do think in this sort of interim period, especially sort of in my lifetime, that you will see banks playing quite a large role in open permissionless networks. Yeah.
Okay, so this is where the questions are just going to get tougher, right? I'm going to challenge you guys, okay? All of this sounds fantastic. But there's a massive curveball coming that could smash all of this apart. Regulation. So where are we on the state? And I know it changes on a daily basis. There was something that happened in the US a few days ago, and we can talk about that. Where are we with regulation and governmental acceptance around DeFi?
Sure. So what's been quite interesting, especially in this latest US infrastructure bill, is that governments have really shown their hand in what they're actually concerned about. And it seems quite apparent that they're actually concerned about Ethereum and DeFi, more so than they are concerned about Bitcoin. And
yeah.
I guess if you took like a sinister approach to thinking about governments, you would reach the conclusion that, okay, cool, the infrastructure bill was there to sort of cut the knees of proof of stake based networks. And that would make it look like people were promoting Bitcoin at a government level, only for them to then regulate Bitcoin out of existence due to environmental concerns, right? Like it's really interesting to see Democrats in America advocating for sort of looser regulations around proof of work, when the last sort of couple of months, the whole focus has been on this whole ESG narrative and Bitcoin's energy consumption, right? So a lot of weird, like sort of paradoxes that we're seeing coming out of regulators, and also a massive signal that they're a lot more concerned about DeFi. So in this infrastructure bill, what they're really trying to do, whether it was knowingly or unknowingly, remember, this is a whole bunch of people that have maybe read one or two blog posts about Ethereum and are now trying to regulate it. Even the language in the legislation proves that they actually have no idea what they're talking about. They talk about how miners are the ones that validate transactions, when in reality, miners essentially order transactions into blocks, and nodes validate whether they are true or not based on the consensus rules that they run. So you can even see in their language and legislation that they literally are really struggling to come to grips with this. These are people that don't use the internet on a day-to-day basis. They haven't had Facebook accounts for the majority of their lives. They haven't. Yeah. So it's a weird one. But basically, what the bill is trying to do, and like I said, either knowingly or unknowingly, that's still to be seen, is classify so many stakeholders in the sort of crypto ecosystem as brokers or money transmitters, right? So from developers, for example, a guy like Hayden Adams, the guy that created Uniswap, they would now like a protocol developer to comply with all the traditional sort of requirements of a broker, right? Anyone who's allowing people to move money. These rules should not be applied to people contributing resources to a decentralized network, right? There is no way that a protocol dev or a node can tell you the name of everyone who's sort of transacting on that network, right? They don't know them either. So it would be impossible for the broader stakeholder community to actually comply with the regulations that the US infrastructure.
But that's a good point. I want to then, and I'll target this at Mike. There's a very important question we need to answer here. Okay. In the previous video that we did, we spoke about Austrian economics. As Austrian economics essentially talks about the free market, less regulation, let the market be free and let actors act as long as they're not breaking any laws. And there's something inside me, and I guess a lot of people, that really wants to see DeFi being set free. Little regulation as possible. But my question is, where is the balance between a free market and stopping a Wild West scenario? Because we've seen, let's just be honest here, we've seen some crazy things in the world of DeFi, and people get burnt. People who don't know what they're doing. The interfaces are still very complex for the average man, just using things like MetaMask. So while we like Austrian economics and freedom, what do you think will ultimately be that balance between having freedoms around the globe, but balancing that with some form of regulation? Where will it settle?
100%. So firstly, I think something we've got to accept is that regulation is an inevitability. It's going to happen. Governments have traditionally liked to be able to control, whether it's good or for bad. It is something we need to accept. And I think as we see, firstly, so also something we need to remember is that regulation, especially for crypto, is going to take a very long time. So governments across the globe are all going to have very different regulatory approaches, and that's going to create very interesting dynamics. I'm not sure if we touched on in the Bitcoin argument, but the regulatory arbitrage of these networks. Now that Germany have allowed crypto to, or at least you're not charged on crypto transactions, and they're starting to allow certain funds to invest in crypto, and they're allowing certain specific actions around the blockchain industry. If America had to turn around tomorrow and say, well, those aren't allowed, everyone that would be developing in America would suddenly go over to Germany. So this firstly introduces a very interesting dynamic about how crypto is going to be regulated. We do agree with you. Obviously, you got our opinion last time that we are Austrian economists. We believe in freedom. Everyone should have the ability. But again, I suppose freedom comes with responsibility as well. We have seen people subjected to big losses in the space, whether through scams, whether through poor smart contract coding. There have been many reasons as to why people have lost money. So regulation is obviously encouraged to a certain extent, and we do need to be able to protect the end users of these networks, because a lot of people, as you say, are jumping on. They don't understand how they're interacting with these actual underlying networks, and it's resulted in big capital losses for a lot of people, which a lot of people, again, firstly, we would always say, don't put in more than you can afford to lose. Don't, put your life savings into a liquidity pool because you're suddenly getting promised $1 million APY. If it's too good to be true, it usually is. So we definitely need some form of protection for users of these networks. But I think the biggest kind of risk we're looking at now is blanket regulation. So as Jason said, there's no separation of brokers and node runners running nodes. And that can be very, very hurtful to an industry when there's poor understanding of what they're trying to regulate, and then actually enacting regulation that shouldn't be applied in the first place. We have seen a lot of countries across the globe taking kind of more proactive, let's work, let's watch, let's wait and see. We also have seen governments now trying to force through regulation because maybe they'll get a bit of extra tax money, whatever it is. They've got their own reasons, but I think regulation is definitely necessary to protect people and users of these networks. However, blanket regulation is probably going to be the biggest single threat to these networks if they aren't understood and regulated accordingly.
Right.
Can I just add to that, Tavish? It's so the way in which crypto is going to bridge this sort of divide, right, is number one, more availability to the underlying code, right? So often when you're interacting with a DeFi network, you can't actually gain access to its code, right? So that needs to become more of an industry standard, right? It needs to, your first warning sign is if you're interacting with flippin' Iron Finance, and you can't directly read its code, which people actually could, and if you'd read its code, you would have found that there was parts to it that allowed the creator of that contract to be able to essentially adjust supply and the rest, right? So there needs to be some kind of standard around disclosures of the code of any given smart contract, right? So that's going to be an industry self-regulation type of thing, right? It should be on the front page of any application. You should be able to quickly click on it and have sort of high degrees of certainty that that is in fact the code that you're running, right? So that would be sort of number one for me. Another big one is obviously just around smart contract audits. And, if companies like, and I must say the audit firms in crypto are probably the most interesting at the moment. They are the most innovative, the most forward thinking, and they're really working towards integrating themselves into this universe. Now, if I can know that, this particular smart contract was audited by PwC and was reviewed by another audit firm, maybe Moore or something like that, I would have a lot higher degrees of certainty that this contract is going to work in the way that I want it to. And then the last piece to that is, and this is something that a lot of people in crypto seem to forget, but these crypto ledgers are incredibly easy to follow someone through the system, right? So blockchains are created for that exact reason. Now, going back to the 3 value nets, okay, all that governments really need to get really right is regulating their closed CBDC networks, their open permissioned banking networks, and then the interaction between those two, right? So where you off ramp and on ramp into different internets of value is where there should be huge regulatory focus, right? So businesses like Luno, Binance, Valar, and the rest of them, they should be highly regulated. They should KYC and AML every single client. And that to me, I think would be quite fair, because as long as you regulate them going in, as long as you have an understanding of what they entered this open permissionless world with, then you can tax them, understand them, and the rest of them when they try and come back to the sort of permissioned world. So three things, right? A common standard for allowing users to actually read the underlying source code, a common sort of standard for smart contract audits, and then the ability to KYC on and off ramps, I think is the thing that really bridges us to a more stable, more regulated environment.
Perfect. I think, though, there will always be people who want the unregulated world, but perhaps that will just exist as a very tiny alternative somewhere out there in the globe, you know. It'll be
Regulation's such a horrible conversation, right? Because it's like these guys aren't paid to take risks, right? They're like, that's not part of what they do. They're literally paid not to take risks. So as an industry, instead of sort of fighting their inability to take risks, we should be sort of eliminating those risks in their entirety. And that is happening in real time. Maybe it's not spoken about that much, but there are companies that exist that are going to not help governments control people on blockchains, but help governments avoid bad actors on these blockchains, right? Like, you know, if some guy who runs some like child trafficking organization has to be KYC before he enters the open permissionless world that is Ethereum, that's what we need. That's where we need to get to, right? Like, and businesses like Chain and Analysis are doing just that, and all the audit firms are building frameworks to be able to do these things.
Yeah.
So it is coming.
So just one more thing on this to wrap up this section. I mentioned MetaMask, and there are a few interfaces. There are things like Compound, Maker that people know about. I know this is a discussion on its own, but just tell us a bit about the DeFi stack and how that looks today.
Yeah, awesome. So we're going to start right at the bottom of the stack, which is very similar to the bottom of the stack we have today in society, right? And that's units of value. Okay, so every single financial function in DeFi requires you to use some kind of unit of value. That unit of value can be a stable coin like USDC or USDT. It can be an algorithmically pegged stablecoin like DAI, or it could be a hardcore crypto asset like Bitcoin and Ethereum, right? So that's the first layer of this DeFi stack. We then got up to the sort of transactional layer of the DeFi stack, right? So this is the layer that processes, executes, and settles transaction requests of users. And that would be something like Ethereum. I wouldn't say that Bitcoin sort of fits into that sort of area, because it can't process sort of conditional agreements. It can't run smart contracts at scale. So you could think of that transactional layer being things like Ethereum. I'm not going to say bloody Cardano, but maybe something like Polkadot, Solana would be.
Well, why? That's another question that we can come to, or maybe we do it right now at this level. What's your view on other chains? And yeah.
Look, we buy into a multi-chain universe, and I'm sorry that I keep on going back to this, but I just think that it's so core for people to get right. Enabled for the masses, enabled for the few, enabled for the privileged. We will see blockchains leveraging one another in order to granularize for particular financial functions, right? So right now we are seeing this play out with something like Solana. Okay, Solana is this high-speed blockchain that, yes, maybe doesn't have as much security as an Ethereum or a Bitcoin, but due to its speed, due to the compromises that it made in the design decisions that we call the blockchain trilemma, it opens itself up to a whole bunch of new use cases. Now, it would be remedial for these other blockchains to peg themselves to the security that something like Ethereum can offer. So we do believe in a multi-chain universe where you've got different blockchains granularizing for specific use cases. right now, Ethereum seems like the main underlying asset agnostic settlement system for the entire digital economy. But we do see a need for things like Solana to granularize and make use cases like order book exchanges possible, which just aren't possible on something like Ethereum today. And I don't even think with ETH 2.0 they'll be possible, right? So there is a place for different blockchains to shine. And as long as they constantly focus on making that crypto cost, so the cost that goes into providing guarantees of any particular use case, lower than the traditional recourse to Turing cost of that use case, they should be successful over the long run. I don't buy into this idea that it's going to be a one chain wins everything. I think that different blockchains will service different.
I was talking to Greg Foss last week, and he mentioned Bitcoin being a base layer just because of the value of Bitcoin and other things being built on top of that. So I guess you're saying Ethereum should be the base layer of DeFi, even though other chains can offer services on top of that. But Ethereum's decentralization, if I understand you correctly, just gives it that benefit. So then what would be at the very top that we know of today? Because you could go higher and higher.
Yeah, cool. So just above those transactional blockchains like Ethereum, Solana, and Polkadot, you will have your Oracle systems, right? So before we even talk about any sort of financial use case, the most important thing is that any given trust minimized financial application can actually get real world information in order to sort of execute on its agreements, right? So oracles like Chainlink are bringing real world data onto blockchains so that these contracts can self-execute according to that data. So that's the next layer. You can just imagine how catastrophic it would be to DeFi if, for example, there's a couple loans that have been made and the price feed of that asset sort of breaks down, right? Oracles are essential to the operations of DeFi. Above that would be these sort of financial primitives, right? So financial primitives, and Mike sort of touched on this a little bit earlier, but if I had to explain it to a 5-year-old, I would say, think of money verbs, right? What can I do with my money? I can buy something with my money. I can invest in something. I can take out leverage. I can make an exchange of an asset, or I can stake something, or I can earn money, right? So financial primitives would be essentially all of those basic money verbs. Right now, the strongest primitives and things that are really capturing our attention is decentralized exchanges, decentralized lending and borrowing, decentralized asset management, and then possibly the most interesting piece of the puzzle being the derivatives sort of market that we're seeing in the crypto space. You're on mute.
Let's talk about that. Sorry, there's some background noise here, right? Let's unpack the derivatives market for the layman. Now, I started doing research into this post 2008, and after what happened with tranches and securities, but my understanding, and you'll probably describe it a lot better than me, is that you can take out a futures contract on just about anything, commodity, gold, oil, or even something like wheat. And you can then trade derivatives. You have calls and puts and things like that. How would you explain that to a 5-year-old, if that's even possible? That whole market before trying to figure out how DeFi could really take over that market in a sense, or that space.
Cool. So explaining it to a 5-year-old, I don't know if I'm at that level yet, but I'll explain it to a first-year university graduate.
Right.
I think I've got a bit more work to do before I'm explaining it to a 5-year-old. All right. So the first sort of thing to get about derivatives, in my sort of view, is that their use case in society, I think, has become a little bit distorted. So a lot of people think about the futures market and options markets as a way to speculate, as opposed to what its first principles use case was, and that was for hedging, right, for the elimination of risk. In having derivatives markets builds a hell of a lot more certainty into economies in general, right? Participants in that economy can utilize derivatives like futures, forwards, and options in order to hedge out risks in the prices of commodities that they use as inputs to goods that they make, or they can hedge, I don't know, particular weather occurrences if they're farmers. So what the derivatives market does at its most basic, instead of like thinking about it as like, oh, derivatives are where hedge funds go to make money. The reality is derivatives were created so that human beings could eliminate risks. Um, so if you take it from that standpoint, um, if we put the ability to hedge risks into the pockets of the everyday individual, as opposed to that whole sort of three phases of masses, few, and privileged, we can provide more certainty in the lives of the everyday individual. And I think that those derivatives, especially in crypto, will be gamified to the extent that the normal, average, everyday individual will be able to interact with what has traditionally been a very complicated um, sort of financial instrument. And it will be abstracted to the point that they will be able to use it in an understandable way. So you can look at networks like what's it called? Its ticker is HXRO. Anyway, it's like a gamified options trading platform, and basically what it does is really reduce the barriers to understanding what any given derivative is, and putting it into layman's terms. It's almost taking like um, financial jargon and putting it into like natural language that someone can understand, right? And gamifying the process for doing so. So um, Ethereum can, if it fulfills its sort of role in society in becoming this asset agnostic platform for settlement, it can democratize access to the ability to eliminate risks in your life. And all you'll need is an internet connection to do so. When you look at derivatives in crypto, I guess the most difficult problem that we're dealing with right now is that you've got blockchain based assets and you've got non-blockchain based assets, right? Um, when it comes to blockchain based assets, it's incredibly easy to run derivatives markets because the underlying can actually be held in a smart contract, right? And then can be redistributed as needed. When it comes to non-blockchain based assets, so our ability to have derivatives markets for commodities or traditional fiat currencies or stocks and shares, that gets slightly more complicated, right? Because you have to replicate the prices of those assets without actually holding those underlying assets. As soon as you hold those underlying assets, you're going to have some traditional finance player in the game. And that's going to create some kind of central point of failure, right? So it could never really be considered DeFi. Until we see these non-blockchain based assets becoming tokenized and becoming native to Ethereum, it's going to be quite difficult to actually have derivatives markets for them. Um, so
Don't you want to explain the process of tokenizing an asset onto something like Ethereum? I've heard of this a lot. How does that work?
okay, cool. So there's two instruments on Ethereum, and there's many more, but these are the two most sort of prolific ones, right? There's the ERC20 token standard. If I had to like really bring it down to its most basic, ERC20 tokens are for financial instruments that should be fungible, right? And then there's the ERC721 standard, and that would be for assets that should not be fungible, right? So they should have some like unique characteristics. Um, most most of the sort of most of the derivatives that we are seeing right now, if it's on like something like synthetics or Mirror Protocol, or even one of our mates is building one, John Clark is building Float Capital, that we can touch on its novel design at a bit of a later stage. But all of these guys seem to be using ERC20 tokens, right? So fungible tokens to represent claims on an asset. So in the same way that I would normally get like a share certificate or a title deed or a bond certificate, that bond certificate, share certificate, title deed is now being abstracted into a cryptographic token that represents ownership in any given asset, right? So you can now have, with time, I think that you will have a tokenized title deed to your home. And all that would require for a transfer to take place is money would be held just like it is in a traditional property transfer by some kind of escrow agent or trustee. And when that cryptographic token that represents ownership has finally been transferred, then the money attached to that agreement will be transferred as well. So really, tokenization is just the process of taking certificates of ownership and making them native to the Ethereum blockchain, either applying the ERC20 token standard, which caters towards fungible assets, or the ERC721 token standard, which caters towards non-fungible assets.
Okay, great. So I want to start maybe wrapping up a little bit. And I think let's talk about, we did cover other smart chains. So that's something I wanted to talk about. Let's talk about business implications. So not specifically banks and fintechs. If I'm a business, what does this new efficiency bring to me, and how could it change business, the speed of business, the reach of business? What's your view on that?
Cool. Okay, so one thing that, like, before, to really understand what Ethereum is going to do to business, or what blockchains in general are going to do to business, is talking to the flexibility and usability that something like Ethereum provides, right? So Ethereum achieves something that's quite unique for software, flexibility and usability. Most software builds to cater towards some very, very specific nuanced thing, and it does it incredibly well, and it can do it well over time, right? Ethereum is incredibly usable and flexible, and this is as a result of its the fact that it's Turing complete, right? So the fact that you can essentially ask the Ethereum virtual machine to compute anything as long as you provide some kind of reasonable resources to do so, right? So that's number one, composability, or not composability, Turing completeness. And then the second one is composability. Mike hit on this a little bit earlier, but composability is this idea that we can take an input, or we can take an output of something and make it the input of something else, right? So there was a paper called, I think it was called Own the Internet. Forgive me, I can't remember the author's name, but it was brilliant. And he drew the analog between Ethereum and Excel, right? So when you use Excel, you can layer different functions on top of one another. And through additional things like Lambda and Excel and the rest of it, it actually means that anyone can come and build a function. And then that function can be used as an input in another function that someone else creates, right? So when it comes to business, I think that Ethereum creates this really fertile soil for experimentation and the layering of the successes of many other developers and financial innovators in the system. In that, like, Mike and I can essentially build a business on Ethereum today that leverages 5 different financial primitives and caters towards something super specific, right? So let's pretend I wanted to build a structured product, right? So something like a Bitcoin covered call strategy, or introduce tranches into some kind of fixed income market. I could, without the permission of anyone, hey, I don't have to call these guys, I don't have to sit through legal proceedings, I don't have to make deals, I don't have to do any of that. The code is there, I can use it. I can layer a lending facility on top of a derivatives market into my application. So my application is built on the successes of others, and the successes of others compound through others entering the system. So it's this massively powerful network effect. Essentially anyone can utilize the successes of others, right? I think that is incredible. When you think of, like, the siloed business environment that we operate in today, it's very difficult to share in the successes of other businesses.
Yeah.
Um,
So effectively, there will be society changing implications for a mature Ethereum ecosystem. That's what we're saying.
yeah.
Yeah.
Yeah. I think that, like, we went through this massive ESG conversation about crypto the other day. And what fascinates me about ESG is that the whole conversation was around the E. There was nothing around the S and the G. Okay,
Yeah.
so let's run through how the exchanges that I use on a daily basis work compared to something like the New York Stock Exchange, right? So I use Uniswap on a daily basis. That's been it's been quite hectic because I've spent so much money on gas fees, but it is what it is.
For people that don't know, what can I do with Uniswap compared
Okay,
to?
cool. So Uniswap is a peer-to-contract exchange, right? So you can buy assets on Uniswap. So you can, let's pretend you got some US dollars or you got some USDC. You can take that USDC and you can buy essentially any Ethereum-based asset on Uniswap. What's also really cool about Uniswap is it applies this very novel market making mechanism, um, which they call automated market makers. It's basically a constant product function. So what's quite cool about something like Uniswap is that traditionally I would buy an asset at, let's say, Charles Schwab. Okay, and Charles Schwab would then custody that asset for me, but they would most likely take that asset and make markets on the Nasdaq, and they would earn fees for doing so, right? We don't get paid those fees on our idle assets. So what's quite cool about Uniswap is that not only can you go there to exchange assets, but you can also take your assets and participate in market making and earn exchange fees for doing so, right? And due to its novel design, this sort of automated market making system where people supply assets of an equal ratio into a pool, and then the price of those assets is determined by fluctuations in that ratio. It is quite interesting, especially for like more exotic pairs and things like that. So if I was a private company down the line, once regulations make sense, but if I was a private company looking for some public funding, I could actually go create an asset on Uniswap. I could then provide liquidity so that people who were interested in purchasing it could actually get liquidity and buy that asset. It wouldn't be so great for people performing very large transactions, but it would be brilliant for people performing relatively small transactions, and they could perform those transactions with very low slippage and essentially infinite liquidity. So Uniswap is, yeah, at its most basic, it's a trust minimized exchange where peers can trade against a contract that holds a ratio of assets.
I'm starting to think that the DeFi swap needs it. The DeFi stack needs an entire episode for itself. It's just growing, right?
100%. Can I add to that quickly?
Yeah, I was going to go to you, Michael. Yeah, go ahead.
What these things are is just settlement infrastructure, and it's agnostic, which means it really can settle anything that you wanted to settle at the end of the day. And what Jason, he's been speaking to, actually starting to decentralize the infrastructure of the financial system. ETH is going to actually enable this for other use cases as well, something like Web3. We can now decentralize the internet infrastructure. So as it currently works, something like Amazon Web Services will go buy up expensive computational power and storage resources in order to be able to deliver a service to you as the end user at the end of the day. And it's been hugely successful. I mean, you can think about what cloud computing has done for majority of businesses across the globe. You don't have to buy up this expensive infrastructure and maintain it and continuously, bear costs of other people coming in to fix it or whatever it is. And this has actually resulted in massive brand new business models that have been enabled by something like this. And for the first time now, something like a Uniswap will give you governance over the platform as well. And essentially that means that we're moving now from the stake, from the shareholder economy, where all the interactions I have with Amazon Web Services only benefits the shareholders of Amazon at the end of the day. Something where it can benefit every person in the system, a stakeholder type environment. So you now, as a user of something like one of the things that is competing with an Amazon Web Services is something like FilePoint. So now instead of just being able to pull resources, you can contribute resources, you can help govern, and you can be rewarded for participating within the network. And that's a massive business model shift from where we've gone from the shareholder to the stakeholder economy. And I think that's one of the most core kind of movements within the whole Ethereum ecosystem is the shift to shareholders benefiting from the actual service at the end of it.
Yeah, I mean, just to build onto that, like Ethereum really is a platform for human coordination. That's where I was sort of going on that whole ESG conversation. And it takes the principles of social capital and the ability to govern. It almost injects steroids into them and makes them possible in real time today, right? So when Ethereum, for example, I mean, not Ethereum, Uniswap, the other day had a proposal submitted to Uniswap users and governance that they were going to launch a DeFi education sort of fund or business, right? And they were going to fund someone who was going to go and do DeFi education. Now, as a Uniswap user with my Uni tokens, I can actually go vote on whether assets from Uniswap's treasury are going to be used in that process or not. And this, when you start thinking about the social and the governance implications of this, we take all the work that the ESG movement has done so far, and we slap on a piece of technology that can make it work properly, so that can avoid the bureaucracy in governments, or not governments, but governance, that can create true stakeholder-based economies, as opposed to shareholder-based economies where they try their best to incentivize and keep stakeholders interested. It ties users into not just the network effect of the service that it can offer, but also the network effect of the financial success of that service, which is truly a massive paradigm shift for our businesses.
So this comes back to the benefits to society that the decentralized model would bring in the future, right? So guys, I think I want to start really wrapping up. So it feels like we've gone on for about an hour, just over an hour, but we really only scratched the surface. There's just so much to talk about here. It's the next internet, as you were saying, Michael. So I guess in future we'll deep dive the DeFi stack, and we can talk about Web3 and really cutting edge, exciting things. I mean, if you add things like virtual reality, as we were talking about before the call, to all this that we've spoken about, wow, we're really going somewhere. And AI, I've wanted to also talk about how an AI would interact with a smart contract in the future autonomously, and it has the power to spend. It could spend and receive crypto. And I believe that smart contracts will take us to this thing called the machine economy. I've theorized about it in articles previously, where AIs are just doing things for the benefit of society on their own. Well, hopefully for the benefit of society, right? But I'll end there for this episode. Wow, this was a great discussion, guys. I'm so glad whenever I get to talk to EtherBridge. We'll do a quick plug. So people don't know about EtherBridge. You've got a very nice newsletter. You've got a great website. Just remind me of that again.
Awesome. Yeah. So our website is just etherbridge.co. So you can go there. You can have a look at things that we do like this, presentations, and various podcasts. You can look at our weekly emails. And then we've also started to write a more sort of it's a more sort of quantitative report on crypto markets, that's sort of usually reserved for like more sophisticated investors to gain an understanding of what it's like actually holding these assets in your portfolio, what benefits they have to you as an investor, and then obviously how EtherBridge sort of fares relative to options you have.
Michael, any closing thoughts from yourself?
No, I think Jason touched on really what we're doing. I think the space that we're involved in is rapidly evolving. And as you say, even these topics that we've spoken about have barely scratched the surface. When people realize these new business models that are going to be enabled by something like Ethereum, I think people will truly start getting it. At EtherBridge, we just constantly here, staying on top of the market, staying on top of these networks, understanding them, understanding how regulation around them is also evolving, and really trying to be able to capture the opportunity that these networks are going to, which is super.
Yeah.
Interesting.
Okay. Okay, we'll end on that note. So we have just scratched the surface in a very long discussion, but I think the gist of what we got through today was FinTech versus DeFi, really, and TradFi. So I hope you enjoyed that. There will most certainly be a follow-up to this. I'm going to have the EtherBridge guys again, etherbridge.co. Subscribe to the weekly newsletter. I certainly look out for it. It's very interesting and informative. And we hope you enjoyed that, and we'll see you again very soon. Until then, have a good day.
Cheers.